We talked about insider buying at the high. And while I don't usually use insider buying as a way to determine whether or not a stock has got it going on, there's one other scenario where insider buying makes for an incredibly bullish tell. And that's when a stock has a huge short position. Meaning a lot of people out there have borrowed shares, sold those shares, and are now waiting for the stock to go lower before they buy them back, return them to the bank they borrowed from, and collect that beautiful difference between the price they sold it first and the price they bought the stock back later. You know, if you can't get your arms around this, I want you to think of shorting as like regular investing, only in reverse. On this show, we try to buy and sell, try to buy low and sell high, right? Isn't that what we do? Shorts just do the opposite. They like to sell high and then they buy low. You each get the difference. When a stock has a lot of shorts in it, that means there are a lot of people who have serious conviction, and that conviction is that the stock's going down. In fact, it takes much more conviction to short a stock than it does to go long. Wall Street speak for buying a stock. Because when you're short, the potential downside, of course, is infinite, right? I mean, a stock can go up forever. But when you're long, a stock beautifully stops at zero. Shorts lose money when stocks go higher, and there's no lid on that. The other important note about short sellers is that if there's a lot of them and a stock all of a sudden gets some great news, we get what's known as a short squeeze. And that's exactly like what it sounds. In order to bail on their positions, the shorts have to buy. This is called covering. When a lot of shorts cover at the same time in a panic, the stock will surge. Because what you really have is a lot of people desperate to buy the stock, a lot of demand, natural or otherwise, but people just have to get it in. They can't take the pain. So where does insider buying fit into the short selling equation? Okay, so you have a stock with a high short interest. And then some of the people who run the company start buying shares for themselves. What a combustible combination. Ready the smoke jumpers. It's almost like drawing a line in the sand for the short, saying, our stock goes this low and no lower. An explosive combination, and one that often leads to a short squeeze that sends the stock much higher. I love this setup. Stocks are smart. In fact, a lot of the time, they tend to be smarter than regular alongside investors, the short sellers. They know they're just... When I hear about someone who's a short seller, I always listen, because they probably know more than I do. They usually don't know more about the business, though, than the insiders who run it, and that's the difference. If a lot of people are shorting a stock and management's buying, do your homework. But usually you're going to want to side with management, not the shorts. And then you can ride it higher and higher, true Jackie Wilson style, as the shorts panic and push shares higher in their desperation to cover their positions and close out their losses. Similarly, when a company with a heavily shorted stock announces a Gigunda buyback, that's another line in the sand situation where management's contradicting the shorts. Companies often repurchase their own shares. Now, look, not all buybacks are bullish. Some of them are just outright wastes of money. And I teach you how to identify bogus buybacks and getting back to even. A substantial new buyback in the face of the shorts, though, is often a good reason to take a closer look. See, that's, in other words, doesn't mean buy, means break out the papers and do the homework. Now, note a caution here. You have to be very careful when dealing with a company that's in the crosshairs of the shorts, especially when people are nervous and the market's in bad shape. The shorts do have the ability to wreck a stock by leaning on it, even if the fundamentals of the underlying company are pretty good. These days, the shorts have more firepower than ever, I believe, thanks in part to the Chris Cox SEC under George W. Bush, which in its totally ideological, laissez-faire frenzy of deregulation ended up dismantling protections like the uptick rule that had curtailed the ability of short sellers and bear raiders to wreck stocks and foment panic. Ever since these rules were established during the Great Depression, they were established to prevent a repeat of the Great Crash of 1929. History repeats itself. Without those protections, the shorts were able to run wild, practically assassinate the stocks of many financial companies during the crash of 2008, until the generational bottom in March of 2009 put the bulls firmly in charge. So when you're dealing with a heavily shorted stock, we've learned that you have to tread carefully. You can still find great opportunities in stocks where the shorts have overreached and the insiders are buying. But before going into one of those situations, I have to warn you that the balance of power has shifted in recent years in favor of the shorts and against regular investors. That means even if the short sellers are wrong about a company's prospects, they can still demolish the stock. Just don't underestimate the amount of damage the shorts can do. Here's the bottom line. Insider buying plus heavy short interest can equal raging buy, as long as you avoid situations where the shorts are determined to crush the stock at any cost.